So why has the market rallied so well off of those June lows? Welcome to the latest LPL Street View. Inflation is still way too high, Russia is still bombing its neighbor, and mortgage rates are 2.5 percentage points above where they were a year ago. Yet the equity markets have rallied quite a bit since June. The S&P 500 is up double digits from June 16, and as of today retraced a good deal of its decline and now well over half its way back to its all-time high. So what supports a rebound like this? Here are a few reasons why investor risk appetite has improved. First, consumer inflation is showing signs of easing. The headline consumer price index eased in July to 8.5% year over year from 9.1% in June. Still way above the Federal Reserve's long-run target rate. The annual rate of inflation does seem to be cooling. Inflation is easing especially for durable goods as prices continue their descent from recent highs. For example, prices for appliances have declined for 3 out of the last 4 months. And used vehicle prices, they declined 4 out of the last 6 months. The July inflation report changed the market's expectations about future Fed activity. And as inflation eases, the Fed can now tighten monetary policy at a slower pace. The Fed still has a lot of work to do, but pricing pressures seem to be easing. Second, falling import prices are evidence of overall easing pricing pressures. A strong U.S. dollar is bolstering the buying power of domestic firms and likely explains some of the decline in import prices. We should point out that imported food and beverage prices have declined for 3 consecutive months in July and is likely the beginning of a long process of overall price normalization. Falling prices for imported food and drinks are especially encouraging given the ongoing disruptions in Ukraine, a key exporter of agricultural commodities. Third, producer prices fell in July, pulling down the year-over-year rate of growth from the extremely fast growth rates earlier this year. We expect producer prices to ease as supply chains improve, but it will take some time before the inflation pipeline cools down to levels acceptable to the Fed. I think what best explains the recent uptick in risk appetite is the market's favorable response to these data and the markets being comfortable in their belief that the Fed can indeed stick a soft landing.